Still ahead, all eyes on the Fed. The U.S. central bank set to hold rates steady despite calls from President Trump for a deep cut. But attention will be on what the Fed says after. We will look at what to expect with market gauges, Michelle Schneider, oil, Wall Street, and the U.S. economy also on the agenda. Oil prices climbed higher again overnight after U.S. President Donald Trump demanded Iran's unconditional surrender. Brent moving $77 a barrel, WTI about $75.35 there. And as the conflict between Israel and Iran continued into a fifth day, Wall Street closed lower as investors took risk off the table. All three majors closed in the red. Sentiment also weakened by fresh retail sales data that weighed on stocks. Sales dipped 0.9% on month, retreating more than expected. And the data comes ahead of the Federal Reserve's meeting later, where the central bank is largely expected to hold rates steady. For a closer look, we're joined by Michelle Schneider. She is a chief strategist at marketgauge. So, Michelle, thanks for joining us again this morning. So, markets down again in reaction to developments in the Middle East. Now, how significant is the risk of a broader U.S. involvement for global asset prices?
Well, I would say right now it looks like the needle is pointing in a U.S. intervention of some sort. How far, we don't know, of course. But what was really interesting in terms of the hard assets, particularly looking at oil, was this was something that was on our radar for a while, oil prices, as sort of the X factor, the one thing that the Fed and all economists could actually look at and say, okay, inflation's not so bad because oil and gas prices were down. But we had a situation developing all year with a lot of demand for energy that wasn't being met. And we had on top of that, the producers of oil not wanting to either drill or refine oil with it being so cheap. So the surplus of oil was starting to go down. The shale oil was already starting to peak. And on top of that, after OPEC Plus met, it didn't exactly have the result in the oil market that people expected, which was a drop down to 40. Instead, it held and cleared a key level. That was before we're at right now. So I don't think that people can underestimate at this point not only the implication to oil supply, and we had today a drawdown of 10 million barrels here in terms of our strategic reserves, but also what it means globally for oil. China's a big user of Iranian oil. And then what does it mean for the energy demand as we go into peak season, right? Summer, we have a lot of pressure on the grid system here for that. AI data centers just constantly increasing, creating more demand for energy. And oil, which was really kind of fourth on the list, now becoming prominent, will have a trickle effect and probably influence all types of energy and their prices.
Yeah, and so really, how should investors be thinking about their energy exposure now, and also where you see crude prices headed? So if they stay, say, $75 to $80, I mean, what does this mean for inflation and the central bank policy ahead as well?
Well, right. And well, in terms of, I think people have to be very careful because there's still a lot of calls for the possibility of an oversupply of oil, which we're just not seeing, right? So I think people have to realize now that oil prices not only are most likely going up, but this is certainly not a repeat of the Persian Gulf War in 1990, when it was resolved very quickly. Oil spiked to $100 a barrel, came right down. This is a far more complex situation in a far more complex time. So let's go to inflation. What this means is that oil producing anything, price is going to go up. Even uranium, which has had quite a nice move lately off the lows, will be more expensive to mine as the cost of oil increases the prices of everything that require it. So where does that leave the retail space and the consumer and inflation? Probably looking at a lot more pain. That's even with before tariffs. That's now the new X factor on the back table, so to speak. So where does that leave the Fed? The Fed is looking at a classic stagflation at this point, because we've seen things really contract in the U.S. economy, although not to recession point. So they don't want to necessarily see the economy collapse, especially in a global crisis. And they certainly don't want to see inflation get out of control. So that's why they'll probably stay the course when they meet tomorrow in the U.S. But the question is, going forward, I would imagine that these are the sort of things we're going to hear Powell say. How long does this conflict in the Middle East go on? What happens to the prices of other commodities and the costs of food? We have a lot of, by the way, high costs in food going on right now. Live cattle, new all-time highs. Soybean, corn, wheat starting to percolate. Natural gas starting to get more expensive. So you have a real conundrum for the Fed. I think this is the toughest monetary policy that any Fed chairman could possibly imagine. And I'm sure he's not feeling really optimistic right now about making the right decision.
Yeah, Michelle, I mean, do you have any idea or expectation which way he could move? I mean, which is the priority now? Is it still fighting inflation? I mean, we are seeing also, weakening in the labor market, weakening consumer spending. So, what is the kind of stance he's likely to take?
Well, as far as he has sort of intimated and other Fed members have said recently, is they are trying to gear towards some kind of a summer rate cut. And especially since the summer anyway generally has its own set of issues with things slowing down until we get to the seasonal fall when kids go back to school and people stop buying again. So this summer is going to be interesting with higher oil and gas prices. So I would imagine he will say that if this is sort of short-lived and we can stabilize in terms of asset prices, particularly in oil and gas and energy and food, then he would be prepared to cut. And that might be enough for the market to move a little bit higher. But at this point, that dismisses all our other problems, which is high debt, high spending. You can sort of go on and on. A dollar that has fallen, even though it had a little bit of a rally today, it's still sort of in an overall downtrend. You can kind of count the conundrums here, in which case, if you're an investor, you don't want to chase strength. When we're talking about equities, you want to wait for dips. You want to wait for dips that look like they're not falling knives. And you want to kind of look at gold and silver and oil and natural gas and maybe even some agriculturals at this point as a way to sort of pepper your portfolio and take advantage of whatever happens in the next couple of months.
All right, Michelle. Many thanks for your time today. Michelle Schneider, Chief Strategist at MarketGauge.